Traders Karen join us, Michelle Girard, along with Scott Martin. Michelle, what do you make of this and how broad-based this was?
Oh, it was, as you said, Neil, across the board in terms of job growth. Another thing that's really impressive that us economists like to look at is not only were more people working, but the people who were working, their companies had them working longer hours, which is like the equivalent of another 300,000 plus jobs. So there was a strong labor input, and companies were having their workers making a lot of goods. As you said, it suggests much better momentum at the end of the year than some of the other reports, and certainly than some of the pessimism that has seemed to have overtaken the markets over the last couple of weeks.
You know, I don't know what to get used to here on this, Scott. With Michelle saying that, and all that's very, very true, very obvious. But it's the mere opposite of yesterday. So given these extreme swings, which is accurate?
Well, I don't know yet. I'll tell you tomorrow, or Monday rather, Neil, because I'll tell you, I mean, you're right. The market has been very schizophrenic and not taking its mood meds. And Michelle, I'll tell you, I'm probably one of those pessimists now, because the thing that I do like is the strengthened number today, Neil. You pointed out the broad-based nature of it. But my goodness, guys, we've had these numbers before. I mean, yes, maybe not 312, but we've had easily close to 200,000 K now for several months running. And tell me why the 10-year note rate then has plummeted from, say, 3.2% in October all the way down to a low of, say, 260 or so yesterday. Yes, it bounced back today, but the bond market is trying to tell us something, my friends. So I don't want to be accused of pulling out, or let's say pouring out the party punch here at the party, but the reality is the bond market is saying that there's maybe more disinflation ahead.
You know, Kevin, in the middle of this, we had the Federal Reserve chairman saying, look, I don't see a reason to pounce on anything and willy-nilly raise rates. I'm paraphrasing here, but his message seemed to defy a very strong economic report that you could argue would necessitate him continuing that tightening cycle. What did you make of that?
Yeah, he said that he's going to pay very close attention to financial markets, and the financial markets definitely got his attention the last month. And what financial markets have been saying is that there is some worry out there. So the bond market, the yield curve flattening, the 10-year yield moving down, like was just said, that's indicative of a weakening global economy, where we see most of the weakness outside our borders, but the data here in the United States has been very strong. So you had this wind shear throughout the year. The story here has been very good. We got more evidence of that today. The rest of the world, not so much. And foreign investors have been funneling money into our economy, into our treasury, driving up the price of the treasuries and down the yields. But ultimately, if the global economy erodes too badly, that is going to affect us here at home. So we're right on that precipice where we have to see which way the cat bounces.
Obviously, Michelle, the stock market liked the talk out of the Fed chairman to say they wouldn't willy-nilly move to raise rates right away. We're still factoring, I think, 2 rate hikes this year. Are you?
I am still expecting that the Fed will nudge rates up a little bit more. Again, my outlook is really one for the economy to continue to perform well. I mean, I think a big point about today's number, as you said, in the context of the weakness yesterday, is that you can't take any one piece of information, as the rule of, as the gospel. Right. The bottom line is the economy doesn't swing from growth to recession back to strong growth like these economic indicators do. And I think what today did was remind people that, hey, the global economy may be a bit slower. U.S. growth may be a little bit slower. But it's a very different thing to be talking about slowing from over 3% in 2018 to maybe around 2.5% in 2019. That is not a recession forecast. It's still above trend growth. And it still potentially would keep the Fed saying, hey, we should be very cautious about raising rates too much, but also about falling behind the curve if, in fact, the economy does perform better and we do start to see an inflation pick up.
You know, Scott Martin, when it comes to the Federal Reserve, he was asked point blank about this, but Jerome Powell said even if the president asked him to resign, he wouldn't. What did you make of it?
Thought it was a good answer. I guess he's somewhat confident today, maybe more so, Neil, with the market going up the way it was after his comments. I mean, gosh, you know, you could attribute maybe 35 S&P points to Powell and the group today. It was a nice little reunion, by the way, with Bernanke up there, too. Haven't seen him in a while. But I got to disagree with Michelle a little bit. I don't see inflation anywhere.
Was it? It was a monetary Avengers team. You know,
it reminded me of my high school reunion,
right?
Except I was made fun of at that reunion, you know. And what's funny is, too, is to Michelle's point, though, Neil, I don't see inflation anywhere. And that's what I don't get about the Fed. They've been so concerned about inflation. They've been reducing their balance sheet. Yet Powell still has talked about, until today, about this outlook for inflation that I just do not see. So I think they have some room to really pause here. The market's telling them to do that. If they do pause going forward, I think you're going to see the S&P stocks get some support.
Kevin, your quick thoughts on Powell and whether his job is safe?
Yes, his job is safe, but the message in the markets since the market's volatility picked up a couple months ago has been lower expectations for interest rates. It wasn't today. Those expectations started to get backed out of the market through the month of November, through the month of December. All Powell did today was sort of confirm that. And keep in mind, the market was already on a tear coming into the session this morning, and helped by the employment figures, which were very, very strong.
Indeed they were. Guys, I want to thank you all. Happy New Year. We got the first week out of the way, right? All right.